Hello everyone, welcome to this class on revenue law and taxation. Of course, my name is Austin Ingabirano. Many of you know me because I've been teaching you, but today it's a different kind of approach altogether. So we are going to have a pre-recorded lecture and questions shall be welcomed during our live session. To remind you that we are living in a very unprecedented era of COVID-19, so please always remember to wear your mask whenever you're in a public place, and also sanitize or wash your hands frequently to avoid the spread of COVID-19. I love you, and I would want you to keep safe. So in our last class, we looked at startup expenses and depreciable assets, and that is under the topic on deductions. We are looking at allowable deductions under the Income Tax Act. So we are going to build onto that and then look at the next topic for today. So please, I will welcome your questions in our next live class. So as you watch this video, please take down notes, put down your questions, things that may not be clear, so that in our next class you can ask those particular questions. So I will move and we proceed to start on our discussion for the day. So let us start with our topic for today, which is going to be amortization of goodwill. Now, in law, we have particular assets which may not be, tangible. So when we talk about goodwill, it also includes other intangible. I want this slide should include other intangible assets. So these intangible assets may be acquired by a given business, and in acquiring those assets to generate income, that business is allowed a deduction. So I want us to look at that, how the Income Tax Act treats such deductions. Now, one, an intangible asset is amortized over its useful life. So we look at this intangible asset and then we look at how useful will it be and for how long, so that we get a formula on how to calculate the allowable deduction. So to the extent that the useful life of the underlying asset it gives rise to a goodwill can be determined, and then the goodwill may be deductible over that particular useful life. So the Income Tax Act permits a rateable write-off of the basis of an intangible assets over its useful life, and this is provided for under Section 31 of the Income Tax Act Cap 340 as amended. So please read and critically analyze Section 31 to get all the nitty-gritties. What I'm presenting is basically a tip, but the section gives you the nitty-gritties of that provision on how goodwill and other intangible assets are treated. So, like I said, an intangible asset is not physical. It just exists under the contemplation of the law. So, and the main examples that we can look at, the one that you're very probably comfortable with, are some of these intellectual properties. You can talk about a trademark, you can talk about a copyright, or other contractual rights. Now, those are intangible. You cannot touch a copyright. It is some, right or property which is only contemplated by the law. But remember, it has some value, and that right can be transferred. Be it a patent. A patent, you come up with an innovation, then the law grants you exclusivity to utilize this particular invention over a given period of time. And that invention has value. So that value that is intangible, but is, contemplated under the law is what we are looking at. What happens if a business today bought, let me say, got an assignment, they were assigned a copyright in a book for a period of 3 years? Okay, how do they consider that expense that they have incurred if their business is with, if they do business in line with, let me say, distribution of textbooks, and they bought a copyright from an author of a given book? What about a trademark? I may be doing some, I'm into production, then there is someone who has a trademark and I want to benefit from that trademark. Then we enter into some sort of an understanding whereby I utilize this trademark on my goods, and I pay a certain loyalty or fee to the owner of the trademark. How is that money, or how is that payment treated for tax purposes? So that's the purpose of Section 31. And the only controversy that has arisen is with regard to ascertaining the useful life of that particular asset or intangible asset. So when you get that asset, the law under Section 31 specifies that you will be allowed a deduction over the useful life, but sometimes it may be hard to ascertain the useful life. However, the onus of proving the usefulness or the useful life of a given asset is placed on the taxpayer. I don't know, I've posed some questions, as you can see in the slide, whether you think it would simplify the law by specifying a single method and a period for recovering the loss of most acquired intangible assets. That is up for you for discussion, and you can always engage me on that particular, aspect. But to sum it up, when we are looking at amortization of goodwill, the law says you amortize over the useful life. But the beauty of it is that for some intangible assets, let me say a copyright assignment, when it is assigned, in most cases the assignment contract will specify the period of time for the assignment. So you can use that period. Let me say it has been assigned for 2 years. So it means you will amortize that cost on a straight line method for the period of 2 years. If it's a trademark, and we know the useful life of a trademark before its renewal is 5 years, so you amortize the goodwill or the intangible asset in that particular intangible asset, for a period of 2 years. If it's a trademark, rather a patent under the Industrial Property Act, its useful life is 20 years. So it means you're going to amortize that particular asset for a period of 2 years, rather 20 years. So you will have to look at it. If there are contractual rights, the usefulness can be established with some reasonable degree of certainty, because the contract will specify the period, the duration of that particular contract. So those are the key points you need to note in under intangible assets. And again, to add on to that, please note that in order to qualify for a deduction under Section 31, the asset that you're looking at must be acquired by the taxpayer. So therefore, Section 31 cannot apply to a self-created asset by the taxpayer. If you came up with something, the asset, then that cannot be allowed as a deduction. Secondly, for you to qualify for a deduction under this section, then you must also prove that the asset that you acquired, be it a trademark, a copyright, or you bought a shop on goodwill, must have been wholly used in the production of income, which income is included in gross income under Section 17 of the Income Tax Act. We've looked at the definition of what gross income is. Then, so where the asset satisfies the conditions under Section 31, then the expenditure incurred in acquiring the asset is amortized on a straight line basis. When I talk about amortization on a straight line basis, it means that I can explain by way of an example that if a person paid, let me say, 1 million shillings to acquire a trademark, then the person would be entitled to a deduction of 200,000 shillings per year for the 5 years. You know why I use 5 years? Because the useful life of a trademark before its renewal is 5 years. So that is the amortization on a straight line, basis. And there are provided for you a summary on what needs to be proved, or the conditions that must be met for someone to qualify for a deduction under Section 31 of the Income Tax Act. And the summary is there for you. You can read. And if you have any questions, please take note of them, and we shall handle those questions during our live sessions. Okay? Please take note of that. Let us proceed and look at another, allowable deduction. Please note, before I move on to initial allowance, at the beginning of this this course, we talked about the general deductions, there, and when you look at the general deductions, I think it's under section. Okay, I've forgotten the exact section of the law, but the general rule is all expenses of a business are allowed as a deduction. And we said that there are certain deductions which are special in nature, in that for them to be allowed, you must conform to certain conditions. So that's what we are looking at. Now we've looked at deductions with regard to intangible assets and goodwill. Now I want us to look at initial allowance. Now this initial allowance is provided for under Section 27A. That's, I think, the amendment under the Income Tax Act. And that section, the effect that a person is allowed an initial allowance deduction at a rate of 50% of the cost base of any given plant or machinery. That machinery must be wholly used in the production of income, which income must be included in gross income. Remember what we said about general deductions, that any cost of a business, for it to be allowed as a deduction, it must be a cost that has been incurred in the production of income. If it's a private cost, let me say you bought yourself a house for your personal use, that cost cannot be deducted, cannot be allowed as a deduction for purposes of arriving at your chargeable income. So please note. So this initial allowance deduction is applicable to plants and property placed into service for the first time during a year of income in a radius of 50 kilometers from Kampala. I think the taxman had a rationale for setting that requirement. I believe they wanted to, encourage industrialization and building factories to places outside Kampala to avoid the congestion within the capital city. So you can claim for that allowance only if you conform with that your first time you're placing a plant into service for the first time during that year of income, and you are in a radius of at least 50 kilometers outside Kampala. Please note also that the initial allowance is allowed on industrial buildings at a rate of 20% of the cost base of a new industrial building, or an extension of that industrial building on which the construction was commenced on or before 1st July 2000 and placed into service for the first time during the year of income. So initial allowances are granted in addition to the tax depreciation and industrial building allowance, which we've already looked at and explained above. So you see, those are tax incentives that are put in place by the taxman to encourage industrialization and investment within the country. Okay, so we shall proceed and look at another deduction called scientific research expenditure. Now this I want to spend little time. Most of the things are provided for under the law and you can actually read. But the key things, the key points that you have to note is one, that scientific research expenditure is provided for under section 32. And that section allows a deduction for scientific research incurred by a person during a year of income. However, to qualify for that deduction under that particular section, you must meet certain conditions. One, again, the expenditure incurred by the person must be scientific research expenditure. What is scientific research expenditure? That definition is broad and it's defined under the Act. But some of the examples of things which may not be regarded as scientific research may include doing market research, people who do sales promotion of a new product, quality control, cosmetic modification or stylistic changes to existing products or technologies, and management or efficiency surveys. So when you do any of those things which look at bettering your market, that's not considered scientific. So I think scientific must have something new to it for you to qualify for that particular deduction. And there are exclusions of scientific research expenditures. These are listed there, like acquiring a depreciable asset or an intangible asset. Such an expenditure cannot be allowed under this section. The second exclusion is an expenditure incurred when you are acquiring land or building. Probably you may want to use that land or building to undertake your scientific expenditure. But as you know, that land and buildings and other things have different other sections that govern their taxation. Then depreciation deduction may be allowed under section 29 for the cost of constructing a given building. The third exclusion for scientific expenditure is expenditure that is incurred for purposes of ascertaining the existence, location, extent, or quality of a natural deposit like minerals. Such expenditures may be deductible under section 36, provided that the expenditure is scientific research expenditure as defined. It will be fully deductible regardless of whether it's of revenue or of a capital nature. So those are exclusions of what scientific expenditure is. Of course, just like any other expenditure, for a scientific expenditure to be allowed, the expenditure must be incurred by a person in the course of carrying on a business. The income from which is included, it must be included in the gross income. That's a key term whenever we are looking at any given expenditure. Remember, the expenditure must have been incurred in producing gross income. And of course, the items included in gross income are clearly specified under section 17. We've looked at that. And no deduction is allowed for scientific research expenditure in the course of carrying on a business for some other purpose, such as producing exempt income and many other related things. So that is it all about scientific expenditure. I will advise you to read and get the definition under the Income Tax Act of what is included in scientific expenditure. It's a broad definition and you need to look at it. Okay, thank you. So the other expenditure that can be deducted when we are calculating our chargeable income for tax purposes under the Income Tax Act is training expenditure. And I will pose a question. Why do you think that in our case Uganda Revenue Authority allows a taxpayer to deduct a training expenditure? Of course, it is clear that when you have a workforce, you should have a skilled workforce, and that skilled workforce should be able to give you you should use their skills to help you generate more income. So when you generate more income and train other people, then you benefit the wider society, because those skills can be, these people can take these skills, somewhere else even outside your company. But again, Section 33 puts in place conditions that must be fulfilled. Please note, don't pay if you're CEO of a company, then you pay for yourself to go and study self-education purposes, i.e. education of a person incurring the expenditure. Those are not allowed. Whether self-education expenses are deductible will depend on the application of the general principle of deductibility under Section 22(1)(a) and the exclusion in Section 22(3)(d). So, self-education expenses may not be deductible, subject to Section 22 as highlighted. So, to qualify for training expenditure deduction, certain conditions, of course, have to be incurred, rather fulfilled. And one of them is that the person incurring the expenditure must be an employer as defined in Section 2Y. So the person incurring the expenditure must be an employer. Let me say Source Services Limited employs John, Mary and Sarah, and they want them because they are dealing in oil-related activities in the Albertine Graben. They want Sarah to be their health expert, so they fund Sarah to go to the UK to attain a certain course certification in safety-related studies within the oil sector. Okay, now Source Services there is an employer, and it can qualify for the deduction of the training expenditure. And of course, as a general rule, the expenditure must be incurred during a year of income for the training or tertiary education of a citizen or a permanent resident of Uganda. That is very important. You must be a citizen or a permanent resident of Uganda for you to qualify for this, training expenditure. And the requirements are further, highlighted there, that a citizen or a permanent resident benefiting from training must not be an associate of the employer, and an associate is also defined. So the section was trying to guard against tax evasion kind of techniques where people would would send their cousins, sisters-in-law, basically associates for trainings, and then they would claim a deduction. And the definition of a permanent resident is also defined, and you can see it there in the slide in accordance with Section 2, and means who is a resident individual. You refer to Section 9, and he or she must have been present in Uganda for a period or periods in total of 3 or more years. Those definitions you can look at in the Act, but the most important thing I would want you to get to know that the applicability of this deduction, this deduction can only be allowed if you which word can I use? The deduction can only be allowed if you are in position to conform to the requirements that are listed under this particular section. And the different definitions of the people who don't qualify, like relatives, are also defined under the Act, and I will invite you to look at these slides, internalize them, and then know the requirements for someone or an entity to be eligible for deducting that particular expenditure. The requirements continue there, and I advise you to continue and read this, because I've mentioned them at the beginning of this particular slide, so I will not repeat them. Then there is another deduction which is very, very important. In one way or the other, we've all found organizations doing some good work that is, helping poor people, work that is helping the disabled persons. People are into charity work, to give support, let me say, to widows whose property is being taken. There are NGOs in that sector. So the taxman was lenient enough to also think about charitable donations. So when you make a charitable donation, you are allowed a deduction. And if I may bring an example which is very recent, in the recent past when we've been in lockdown because of COVID-19, we had a number of people making donations to the Ministry of Health. I think you watched this, and some people got the benefit of the President of Uganda, reading out their names on TV. And I remember a number of people made donations. They were in thousands, companies and all that. So you can ask yourself a question. Do you think that those donations were deductible? Of course, when you make a donation, the law allows you a deduction. It becomes more or less like an expense. So charitable donations are deductible if they are made to the following organizations. One, they talk about amateur sporting organizations, religious organizations, organizations that are characterized as charities, or educational institutions of a public character. It can be a trade union or other similar associations that have been issued with a written ruling by the Commissioner General currently in force, stating that it is an exempt organization. So that is a classification of the different organizations that can receive, that can get donations, and they are allowed as a deduction. Please note that the donation should not exceed 5% of the person's chargeable income. You know the definition of chargeable income. So I would pose a question to you. If my chargeable income is 50 million for a given year of income, let me say 2019-2020, what will be my limit for a charitable donation? The limit there would be you get 5 divided by 100 multiplied by the 50 million. Then you know that if I'm making donations, I cannot exceed this. It becomes your very last 5%. So under section 34, of course, to qualify for the deduction, again, it also has conditions that must be fulfilled. So one, the gift or the donation must have been made during a year of income, and the gift may be a monetary amount or a transfer of property. So a gift is intended to have its ordinary meaning under the Act. Secondly, the gift must be made to an exempt organization, that is, one, an amateur sporting organization, a charity, an education institution of a public nature, a religious organization, and other related organizations. So it's not every donation that will be allowed as a deduction. The donation must be made to any of those exempt organizations. Thank you. Now, as I sum up, I want us to look at non-allowable deductions. You see, in our day-to-day running of business, there are certain deductions that we incur, non-deductions rather, there are certain expenses that we incur, but the law does not recognize them as allowable deductions. So if something is not allowable, it means you cannot deduct it from your gross income before you arrive at your chargeable income. So it means whether you incur that expenditure will not be allowed by the taxman as a deduction. So some of them I've tried to list them here, and one is that no deduction is allowed for the following expenditures rather. One, any expenditure or loss of a domestic or a private nature. I gave you an example. You buy a house for your private use, not for business. That one is an expenditure of a private nature, and it cannot be allowed as a deduction. Then two, an expenditure or loss of a capital nature. Expenditures or loss of a capital nature are also not allowed. Then expenditure or loss recoverable under insurance contract or indemnity. if you incur an insurable loss and you're going to recover that money from insurance, then the taxman will not allow you a deduction. Then any contribution or similar payment made to a retirement fund by the employee or for the benefit of any other person, e.g., National Social Security Fund contributions. So NSSF contributions are not allowed as deductions for tax purposes. This one is an interesting one. We need to look at it in light of that decision that I shared with you under Section 25 on interest. So again, any premium or similar payments made in respect of life insurance policy for the life of a person paying the premium or on the life of some other person. So premium payments on life insurance policies are also not allowed as deductions for tax purposes. So any income appropriated to reserve fund or capitalized in any way is also not allowed. And then the amount of pension paid to any person is also not allowed as a deduction. Of course, you know that pension is most times paid by government ministries to its employees who have reached the retirement age, so that is not allowed as a deduction. So in summary, there are deductions. We've looked at most of the specific deductions. I won't say that these have been all inclusive. There are others, but you need to take time and look at the act. The Income Tax Act has all that you need to discuss these deductions. And I'll be lying if I told you that I'm going to teach you the nitty-gritties of all the deductions. At least the few complicated deductions, we've looked at them. Depreciation, how do you calculate it? It has schedules. We've looked at those schedules under Part 6 of the Act. You've looked at all that. So the remaining deductions, you can look at the Act from sections, I think, 23 all the way to around section 40, and you'll find all the deductions. And of course, when you're doing your tax practice, you may find that there are other things that will come up. That's why this the law, the Income Tax Act, is always under constant amendments. Whenever a budget comes in, we amend it. So things keep changing and they are not static. Even what I'm telling you, you need to verify a few things here and there. Probably haven't done enough research to, find out whether something has changed, but I know the current position of the law stands. So that's all from me for today. I look forward to meeting you in our live discussion on the online platform, and please remember to always visit the platform. If you haven't registered, please register to make sure that you can access the materials. Additional resources are available on the platform again, and I will not stop emphasizing this, that you need to read and then do your assignments on the platform, including the weekly MCQs. So I look forward to meeting you in our live session, and please take down all the questions. Let's meet in the discussions. Please keep safe and see you soon. Bye-bye.